Hi everyone, I'm Charmaine, a research analyst at iFAST. Today I'm joined by Agustin Mohedas, a portfolio manager and research analyst on the healthcare team at Janus Henderson Investors. In this episode, we take a closer look at the Janus Henderson Horizon Biotech Fund, discussing how the fund capitalizes on the growing demand within the biotech sector and has consistently outperformed the sector index across multiple timeframes. So to start off, how has the biotech sector evolved this year compared to last year, and which growth or areas or therapeutic categories are currently driving the strongest momentum?
Okay, well, thank you for having me. I appreciate the opportunity to talk to you today about biotech. This year has been a roller coaster ride for biotech stocks. Compared to last year, we faced a lot of headwinds at the beginning of the year, specifically three different items. So number one, the appointment of RFK, Robert F. Kennedy Jr., as the head of HHS. RFK was seen as somebody that maybe would be not industry friendly and potentially change the way the FDA does drug approvals. So there was a lot of concern there, as well as concerns around DOGE budget cuts at the FDA and just exactly how the FDA would operate. So that was number one. Number two, tariffs, and both country-specific tariffs and pharmaceutical-specific tariffs. There was a concern that if there was high tariffs placed on pharmaceuticals, that would reduce profitability of the industry. And then number three, most favored nations drug pricing. So this is something Trump has talked a lot about wanting to reduce the price of drugs in the United States and raise the price of drugs outside of the United States. All three of those headwinds were a major problem for the sector in the first half of the year, caused stocks to decline significantly. In particular, the biotech stocks that are in the clinical stages of development. So they're earlier stage, higher risk, and have a long time to get to revenues and profitability. So now fast forward to today, all three of those concerns are being addressed. So I'll talk about the FDA to start. So number one, the FDA is working as expected. We've talked to many of our portfolio companies and they tell us there's been really no major changes at the FDA with respect to the people that review the drugs in development. So that's been really good to see. RFK's changes within the healthcare system have been really limited more towards vaccine. So the vaccine area, which unfortunately does still face headwinds, but the rest of the kind of biopharmaceutical area has not really seen a major negative impact from the FDA. So I think we can kind of rest assured that the FDA is functioning correctly, drugs are being approved, and there hasn't been a big change in the way the FDA approves drugs. So that's great. On the tariff-specific side, country-specific tariffs, I think, are being addressed by country-to-country deals. And we've seen a lot of other sectors rebound off of the April lows associated with tariffs because people are now feeling assured that maybe the tariffs won't have as big of an impact. In terms of pharmaceutical-specific tariffs and most favored nation drug pricing, that is probably the last thing that remains a bit of a headwind, but even here we're seeing a lot of improvements. So number one, we're seeing companies come to the Trump administration and do deals. So you saw Pfizer and AstraZeneca both come to the administration with deals to avoid both tariffs and drug pricing concerns. And the deals involve, number one, investing in manufacturing in the United States. So many companies have announced tens of billions of dollars of investments to make drugs in the United States. This avoids tariffs, of course, by manufacturing them in the United States and doesn't really materially raise the cost that much. And number two, Pfizer and AstraZeneca that have both announced deals with the Trump administration are offering consumers the same drugs that they offer to insurance companies at that same volume discount price. Is what we call the net price. They're offering it direct to consumer so the consumer can access therapies directly as long as they have a prescription for 50 or 60% lower than the list price. So this has given the Trump administration a big win with these two press releases from Pfizer and AstraZeneca. And what we believe will happen is more companies will do similar deals with the Trump administration. And so we will go from having three major headwinds in the sector to now having almost no headwinds and maybe some tailwinds, with the FDA actually saying that they want to approve more drugs, particularly for rare diseases. And so that's why you've seen a big rebound in the sector, but we think it's still early days and will continue.
Thank you so much for sharing the backdrop, involving the biotech sector. So how has Janus Henderson Horizon Biotech Fund actually adapted its investment strategy in response to the current market environment, including interest rate changes, macroeconomic changes, or shift in investor sentiment?
Yeah, so we really haven't changed our approach. We've been managing the strategy now for over 6 years, successfully outperforming the other biotechnology benchmarks, by quite a bit. And the way we do that is really we seek to identify companies that are developing medicines that will change the practice of medicine. So really, truly revolutionary new therapies to treat high unmet medical needs. So things like pancreatic cancer, rare neuromuscular diseases, other rare disorders that don't have any approved therapies. So we seek to identify those companies before the rest of the market can truly appreciate their value, buy those stocks when they're cheap, and then we'll benefit from them. So we really haven't changed our approach. That approach remains that way. We're also diversified, so we're not just invested in the clinical stage companies. Those are the highest risk part of the sector, but we also own many companies that are profitable, companies like Vertex or Amgen that are, really high quality biotechnology businesses that are highly profitable with good growth, no short-term patent expirations. So we look for like high quality profitable companies, as well as companies that are in their early stages of commercialization. So they're launching a new therapy that we think can address a high unmet medical need and has significant revenue growth potential. And it's in really those early stage, it's really in those early commercial companies that we see a lot of M&A activity. And we can talk a little bit more about that if you'd like, but M&A activity has really picked up in the third quarter of this year, and we expect that to continue as well.
So that's interesting to hear because I believe that your fund actually is historically overweight in small and mid-cap biotech companies. So are you maintaining this allocation, and what new criteria or risk consideration are influencing maybe your stock selection?
Yeah, so we are always really excited by the companies doing clinical development. So yes, we still maintain our overweight in those earlier stage, smaller companies because we do think that is the highest growth potential, and it's the way we've outperformed over time. Within that universe of approximately 600 biotech stocks, it's critical to identify the companies that have the most potential. And the reason an active management approach is so important in biotechnology is because 90% of drugs that enter human testing actually will never make it to market. So there's a 90% failure rate. So it's really important that you have a manager that can identify the 10% of drugs that can actually make it to approval. But even then, that's not really enough. You still have to identify the drugs that not only can make it to approval, but will actually have meaningful sales. So we look for companies that can generate at least $1 billion of revenue, because those are the companies that drive profitability for the whole industry. So yes, we maintain our overweight in clinical development stage biotech companies, but within that, we're typically more in the later stage development, like phase 3, which is the last stage of clinical testing. And so we have many companies in that stage of development. And then once they're approved, they become early commercial companies. And so that is really the sweet spot for the fund.
Thank you for clarifying. So can you also provide an update on the fund's top holdings and any new position that have been added this year? And how do these new positions reflect opportunities in innovation, pipeline growth, or market inefficiencies?
Our top holdings really reflect the companies that are later stage, right? That are bigger, that we can hold that as a bigger weight, less risky as well. And so those includes companies that are commercializing drugs like 𝐓𝐡𝐞, which is approved in 2 autoimmune indications. This is the first therapy that can really lower what are called autoantibodies. Autoantibodies can happen in various autoimmune indications, and the company is called argenx, and they're commercializing 𝐓𝐡𝐞. It's doing $4 billion of sales and growing 90% year over year. It's one of our highest conviction ideas. We remain really excited about that, and they have a pipeline of other therapies also in development, and 𝐓𝐡𝐞 itself is in development in over 12 different diseases. So we think that medicine can eventually do 10 to 15 billion of peak sales, so a lot of growth left to come. Some other areas of excitement for us that are in the top holding are neuromuscular diseases. So there's a number of diseases that have really limited therapeutic options, like Duchenne muscular dystrophy or myotonic dystrophy type 1 or FSHD. These are all in a category of neuromuscular diseases, and we have a number of investments. So we have a kind of portfolio approach. We have invested in a number of companies that have new targeted therapies that address the genetic cause of the disease. So many times, therapies address symptoms of a disease, but when we can address the underlying genetic cause of a disease, we can oftentimes have a much more meaningful impact on the course of disease. So we have a number of portfolio holdings in that neuromuscular space that we're really excited about. Another top holding is Revolution Medicines. They're developing a drug for pancreatic cancer. Pancreatic cancer is one of the worst forms of cancer with less than 5% survival at 5 years. So really devastating disease. They have a targeted therapy that targets a protein called KRAS that is mutated in 90% of patients with pancreatic cancer. They'll have the first therapy potentially approved to target this genetic mutation in the disease. They'll have data next year, so we're very excited about that. These are just some examples. We have a broad portfolio. What's important also in biotech is not just to buy individual securities, but to own a portfolio of securities, because any one individual security could, of course, have a negative setback. But a portfolio of well-constructed portfolio that's risk-adjusted, on average, will outperform and deliver good returns. But it's really critical to have someone who knows how to pick those stocks.
That is very reassuring to hear. So what is your outlook on M&A activity and venture capital funding in biotech moving forward? And are there any smaller companies still attractive acquisition targets for large pharmaceutical companies?
Yeah, so I mentioned earlier that M&A was picking back up. I think the reason you're seeing M&A pick back up, and we've had at least 5 companies in the portfolio acquired year to date, and most of that has happened actually in the third quarter of this year. And the reason is in the first half of the year, I mentioned all those headwinds, all those negative headwinds that biopharma was facing. Large pharmaceutical companies don't want to spend money on M&A when the outlook is uncertain. But now that they have more certainty on FDA, more certainty on tariffs, and more certainty on drug pricing, they are starting to deploy capital. So they've acquired multiple assets that we think are really attractive. And there's a lot of our portfolio that probably remains an M&A candidate. I'm not going to go into specific ideas there, but most of our companies are developing drugs that we think are really compelling. And when we think a drug is really compelling, exciting, being developed for a high unmet medical need, oftentimes large pharmaceutical companies agree with us and want to acquire that asset to help offset their patent cliffs. So these patent cliffs remain a significant problem for the large pharmaceutical companies. I'll give you an example. Merck has a drug called 𝐓𝐡𝐞 that they sell for cancer. It's approved in over 30 different types of cancer. That drug is on track to do $30 billion of peak sales, but will go off patent in 2028 to 2030. So by the end of this decade, Merck needs to replace $30 billion of revenue. That's if they just want to stay flat. If they want to grow, they obviously need to replace more than that. Historically, pharmaceutical companies have replaced their revenue by doing internal R&D and developing new drugs internally, but that's only about 1/3 of the revenue they can replace. So 2/3 of the revenue they replace through M&A. So, 𝐓𝐡𝐞 has $30 billion of revenue, $20 billion of that will be replaced through M&A. And it just so happens Merck acquired one of our portfolio companies called Verona Pharmaceuticals that had a new drug in COPD. And we think that drug can do $3 to $5 billion of revenue. So, Merck still has $15 billion of revenue to replace, so they'll likely continue to acquire smaller biotech targets. And so we're really excited about the M&A potential in both the portfolio and the broader industry, because these patent cliffs that large companies have, remain a problem. And the best way they have to solve that is through M&A.
So you listed out the 3 major headwinds that we see at the start of this year. So with all this market turbulence, how has the fund actually performed this year?
Yeah, so I'm happy to report the funds had a really great, strong back half of the year. And despite that market turbulence in the beginning of the year, the fund is now up over 25% year to date. And knock on wood, we're hopeful that can continue because of all the exciting new therapies in development and everything we've talked about.
So are there any other comments you wish to share?
Yeah, no, look, I think we started the year with a lot of negativity. I think it's starting to improve and will continue to do so. But healthcare has lagged some of the broader markets like tech and AI themes, and the valuations remain really, really attractive in this sector, a sector where things are improving, where headwinds have become tailwinds. So I think even though we've had robust growth in the back half of this year, we think there's a long runway to continue.
Thank you, Agustin, for sharing your insights on the biotech sector and also sharing more about the Janus Henderson Biotech Fund. So for viewers who would like to learn more about the fund, you can visit the website or simply scan the QR code on the screen.